Welcome to Module 6 of Accounting 5000. In Module 6 we're going to cover the first part of Chapter 4. In Chapter 4, the first part, we're going to go through the bookkeeping process and look at how the events that we talked about earlier are translated into accounts and finally into financial statements. So let's talk a little bit about the bookkeeping process. Now remember in our previous example we talked about going down to a fast food restaurant and purchasing a hamburger and drink and some fries. We said that that was an economic event because you paid out cash and in return you received your food. That economic event has to be translated into what we call a transaction. In other words, it has to be recorded somehow, written down so that it can end up in the financial statements. So that transaction then is fed into the accounts of the firm. In this case it would be cash and inventory. And then it goes from the accounts to the financial statements. Now, although as a manager you're probably more concerned with the actual results in the financial statements, we're going to have to be able to understand what goes on before you read the financial statements in order for the financial statements to make some sense. So in the first part of Chapter 4, we're going to talk about the bookkeeping process, how it becomes an economic event to a transaction, to the accounts, and finally to the financial statements. In order to do that, let's talk about the actual balance sheet account that we've been talking about, the equation, the basic equation. Remember, we said the equation was A equals L plus OE. Assets equals liabilities plus owner's equity. We can take the owner's equity and break it down into two components. Paid in capital, which we've abbreviated PIC, and retained earnings. We can further break down retained earnings at the end of the period into the beginning retained earnings, BRE, plus our revenues minus our expenses. So realizing that last equation is the key to taking our economic events and translating them into transactions. Let's look at a problem that your text has written about on page 99, Exhibit 4-1. So if you look in your book, what they have done is listed some transactions for you there on the middle of page 98. Things like investors organizing the firm and putting some money in, buying some equipment. Then if you'll turn your book around sideways, on page 99, what they have done is taken those economic events and shown the effect of those events on that balance sheet equation, the last one we had on the previous slide where we broke it down into several parts. That's showing you the events, the economic events, and how they affect the account balances. And then if you read further on, you can see on page 100 at the top of the page, they've taken those account balances after the events have been recorded and have combined them and put them into some financial statements that an investor, a creditor, a manager, or other user of financial statements can actually use. So in order to understand how that happens, let's talk about some of the jargon and some of the events that occur in the accounting process. In the accounting process, everything starts with a journal entry. Now, a journal is like a diary. It's simply an account of everything that happens in chronological order, in the order in which it happened. We take those journal entries and we put them into accounts. Now, we call those accounts combined together a ledger. And if you can think of a ledger as a notebook, and each page of the ledger is an account. So you would have a page for cash, you would have a page for accounts receivable, you would have a page for accounts payable, and so on. All of those combined would be your ledger. So if you think of a journal as a diary and a ledger as a notebook, you can kind of get a handle on how this bookkeeping process is going to work. Now once we have that ledger with all those accounts listed in it, we have to have some way to manage those accounts. So typically what we do is list all of those accounts and the account numbers. We call that a chart of accounts. And all the chart of accounts is a listing of our accounts, and if they have a guiding number for them, we put that in there. That way everybody knows which accounts we're going to be using in our business. Now let's talk about some additional terms. Account balance. Account balance is the amount of money that you have in your account at a particular point in time. For example, if you were looking at your checkbook, your account balance would be the amount of cash that's showing up as the last number in your checkbook. That's your account balance. One of the key terms in accounting is a thing called a T account. Now, a T account looks exactly like a capital T. It's a bar that goes horizontally, it's divided in the middle by a vertical line. That gives you two sides to the T, a left side and a right side. And we use in accounting the terms debit and credit to mean left and right. They don't mean anything else, just left and right. Okay? When my grandson was 2, I taught him how to do debits and credits. I would say debit, and he'd raise his left hand. I'd say credit, he'd raise his right hand. All that is left and right. Don't think of it in terms of a banking situation, a credit card situation. Think of it only in accounting. Debit is left, credit is right. That's all it means. Don't attach any other significance to it at this point. Left and right, debit and credit. We use debit and credits in our T accounts and in our journal entries. When we're writing down what happened in chronological order, we use the same idea of debit and credit. Debit's on the left, credit's on the right. That's all it means. So if you want to see an example of some T accounts, if you look at the bottom of page 101 of your textbook in the yellow box, they have the T accounts for assets, liabilities, and owner's equity. Now what you'll notice is that assets, a debit for an asset is a positive amount. So if you're going to increase the assets, you do it with a debit. Think about your algebra. If you go to the other side of the equation, everything is backwards. And that's true in the accounting equation, because on the other side of the equation, liabilities and owner's equity are increased with credit amounts. So you can see how they're the reverse. So some good examples of debits and credits and a T account is at the bottom of page 101. Now we can take those T accounts and move them into journal entries, because journal entries are where we actually make the entries into our accounting records. We still use debits and credits as right and left, but we do it in a columnar manner. So if you look in the middle of page 103 of your textbook, right about the middle of the page, they have an example journal entry for you in that yellow box. Notice what the components are. You have a date, because remember it's a journal, so it's going to tell you when it happened. You're going to have an account that is debited. It'll be on the left side. You'll have an account that is credited. It will be indented a little bit to the right, almost like a paragraph indentation to the right. Then you will have some amounts, both a debit, which will be on the left side of the journal, and a credit, which will be on the right side. So you will have the components of date, debit, credit, and the amounts. So if you want an example, again, look in your book on page 103 and see what a journal entry looks like. We're going to be journal entering several problems in just a minute, so you need to be aware of what they are. Okay? Let's do some examples now. Let's see what they look like. Let's use problem 4.2 in your textbook as an example of how economic events become transactions and how those transactions affect the accounts and finally the financial statements. So problem 4.2 is on the middle of page 120 of your textbook. As you read through there, you have a mowing service that's just begun operations. And they ask you to prepare a line of accounts, which is in the middle of page 121 on the next page, with cash, accounts receivable, supplies, equipment, notes payable, accounts payable, paid-in capital, retained earnings, revenues, and expenses. You're then to take the A through L items that are listed there and put those underneath those account titles that you have in a horizontal line on your sheet of paper. So let's go through some of those accounts and see what would happen, some of those events. For example, in event A, the firm was organized and the owners invested $600 in cash. If they invested $600 in cash, then the cash of the company went up $600. So you would increase cash $600. Now that's money the owners have invested. So that's paid in capital. That's what the owners have paid in as their capital for that firm. So that increases paid in capital $600. Now if you look at your entry there, you've got 600 equals 0 plus zeros plus on the other side you've got 600. So it's still imbalanced. In part B, the company borrowed $900 from a relative of an owner and they signed a short-term note. If they borrowed $600, then their cash went up, $900, then their cash went up $900. So that's an increase in cash, but it also increases their liability of notes payable. So notes payable will go up $900. Now notice, your equation is still in balance. You have $1,500 in assets and $1,500 in liabilities plus owner's equity. In Part C, you buy 2 lawnmowers that cost $480 each and a trimmer that costs $130. They give you a little bit of a trick to this question because they tell you the original price of the mowers was $610. That doesn't matter to you. Remember, we're using the cost basis in accounting, one of those principles we talked about in Chapter 2. We only record what we actually paid for the item. So we paid $480 times 2, $960, plus $130 for the stringer. So we actually paid $1,090 for our equipment. So paid means that cash went down. Paid is a negative cash. Cash is decreased by $1,090. On the other hand, our equipment asset account goes up $1,090 for the assets we purchased. Now notice we have an asset increase of $1,090 and an asset decrease of $1,090, so our equation is still in balance. On letter D, we're going to buy some gas and oil and trash bags for $90. Now buy or paid means that cash is going to go down, so we're going to spend cash of $90, so we decrease cash $90. And those will be supplies for our mowing services. So our supplies are going to go up. So when asset goes up, we're going to increase the asset of supplies. In letter E, we're going to produce some advertising flyers announcing the formation of the business, and we're going to buy a newspaper ad. Both of those will cost us $170, but we're not going to pay for them right now. We're going to pay for them in 30 days. So we have an expense of $170, but we owe that $170. So our liabilities will go up $170 because we owe for those expenses. And at the same time, our expenses will go up $170. So accounts payables increased $170 and expenses are increased $170. In letter F, during the first 2 weeks of operations, they mowed 47 lawns. That's a lot of lawns. The total revenue for the work was $705. They actually collected in cash $465, and the rest of it's due to them in 30 days. So their cash went up by something, their revenues went up by another number, and the amount that's owed to them, which is accounts receivable, also increased. So you have 3 things happening here. You have cash going up by $465. You have your revenues going up by $705. And the difference between those two numbers is $240, and that's the amount that your accounts receivable increased. So cash was up $465, accounts receivable $240, and your revenues went up $705. In letter G, your employees were paid $420 for their work during the first 2 weeks. Paid. That key word paid tells you that cash went down. So you're going to decrease cash by $420. Those employees working for you help generate that revenue. So those are going to be expenses that you want to match with the revenue you got. So you're going to increase your expenses by $420 and you're going to decrease your cash by $420. In letter H, you bought more gas, oil, and trash bags, and these cost $110. Again, they were purchased for cash, which means you paid out cash of $110. So cash is going to go down $110. And you bought supplies, so you have increased your supplies account by $110. In letter I, during the last 2 weeks of the first month, they had revenues of $920, and they collected $375 of that. So again, their revenues went up, their cash went up, and the amount that's owed to them, which is accounts receivable, also increased. So the cash went up $375, the revenue went up $920. So the difference between those two is the amount that's owed to them are $545. So their accounts receivable went up $545. In letter J, employee wages for the last 2 weeks totaled $510. They're not going to pay these until the first week of next month. So they owe them. Anytime you owe money, that's a liability. In this case, it's going to be an account payable of $510 that's going to increase. Remember, that's an expense. That's how you generated revenue, was paying these people to help you mow the yards. That's an expense of $510. So your expenses go up $510, your accounts payable go up $510. In letter K, it says it's determined that at the end of the month the cost of the oil, gas, and trash bags that you still have left are $30. Now remember, you bought oil and gas and trash bags twice. Back in letter D, you bought $90 worth of those supplies. And then again in letter H, you bought another $110. So you have $200 in supplies. But of that $200 of supplies, you've used all of it up but $30. So you're going to have to decrease your supplies account and move what you've used up into the expense account. So you're going to increase your expenses by $170, which is the difference between the $200 you had in there and the $30 you want to have left. In addition, your supplies have gone down by that $170. So you decrease supplies $170 and increase your expenses $170. Finally, in letter L, the customers have paid a total of $150 that was due from the mowing services they provided in the first 2 weeks. You've already recognized the revenue, so all you're going to do is show that you've collected the cash and that the customers no longer owe you that money. So you're going to reduce accounts receivable by $150, and you're going to increase cash by $150. So you show that cash went up $150 and accounts receivable went down $150. Now if you go through, after you've done all of these events across that horizontal model that you've developed, you should have some totals there. And what I've shown you on the next slide are the totals that you should have for each of those accounts. For example, your cash should be $780, your receivables should be $635, and so on. Now, if we were going to do a set of financial statements, what we would do next is to take these account balances and list them in order and come up with an income statement first and a balance sheet second. We could even do a cash flow statement and a statement of owner's equity if we wanted to. But those account balances are what we use to come up with our financial statements. Okay, let's do something a little bit different now. We've done the transactions, we've put them into accounts. Let's see what those same events look like if we were going to do journal entries. So if you look down at problem 4-4, right in the middle of page 121, what we're going to do now is take those same events that are listed in problem 2 and change them into journal entries. For example, in letter A, the firm was organized and the owners invested cash of $600. If you look back, remember we said that cash went up $600 and our paid-in capital went up $600. Well, to translate that into a journal entry, if cash goes up, that's an asset. And assets are increased with a debit. So we list the debit first, and we make it flush with the left margin. We put our $600 in the first column, the left column. Then we go to the paid-in capital account. It's a credit. An increase to an owner's equity account is a credit. So we show that as a credit by indenting a little bit to the right. And then in the second column, the rightmost column, we put the $600 increase in paid-in capital. In letter B, remember the company borrowed $900 from a relative and they owe that money. We increased cash again by $900. Increasing cash is an increase in an asset, so that's a debit. Notice we list the debits first, flush with the left margin. We then show the $900 in the first column for cash increase. Our liability of notes payable went up, so it was increased. You increase a liability with a credit. So we indent it a little bit to the right, and we write notes payable, and in the rightmost column we enter the $900 increase in notes payable. In C, we bought the lawnmowers and the stringer. Those were equipment items. Equipment is an asset. We're going to increase equipment. So we would debit the asset of equipment, $1,090. Now we took it out of cash. Cash is going to decrease. Now if an asset decreases, that's a credit. So we would indent it a little bit to the right. We would write cash, And in the rightmost column, we would enter 1,090. In letter D, we purchased gas, oil, and trash bags for cash of $90. So again, remember our supplies went up. That's an asset. We increase an asset of supplies by debiting it, moving it to the left side, and putting $90 in it. Now we paid cash for that, and cash is an asset, so to decrease the asset of cash, we're going to credit it, so we indent it a little bit to the right and put the $90 in the rightmost column. In E, the advertising flyers and the newspaper ad cost us $170. That's an expense. Now an expense is increased with a debit. So we would debit expense $170, and we owe that money, so that's a liability. We increase a liability with a credit. So we show it moved over to the right a little bit, $170 credit to accounts payable. In letter F, we mowed the yards and we earned some revenue, part of which we collected and part of which is owed to us. We've increased cash of $465, so that's a debit to cash. We've increased accounts receivable, the amount that's owed to us, $240. And we've increased revenues, and remember revenues is over on the other side of the equation. Revenues are increased with a credit of $705. Now that's an interesting journal entry that you see up there in front of you in letter F. Notice it has three parts, two debits and a credit. The two debits added up will be $705. So all the debits have to equal all the credits. You could have any number of lines in your journal entry. It could be 2, 3, 5, 10. But in any case, the debits will always equal the credits. Always. Remember, the balance sheet has to stay in balance, so debits equal credits. In letter G, we paid our employees. Now again, this is an expense. We increase expenses with a debit. Expenses are just like assets, if you can think of them like assets. Expenses are increased with a debit. Now, we paid them. Is that correct? We paid them. So our cash is going to go down. For our cash to go down, that's a credit because it's an asset account. To decrease it, we credit it. So we're going to debit wages expense and credit cash. In letter H, we buy some more supplies. This is exactly like the previous journal entry, except the dollar amounts are changing. We increase the asset of supplies with a debit of $110, and we decrease the asset of cash with a credit of $110. In I, we have some revenues of $920, and we collect $375. Very similar to the previous entry we had like this. Our revenues are increasing. We increase revenues with a credit. So we're going to credit revenues $920. Of those revenues, we actually got cash, so our cash went up, and that's an asset. So to increase cash, we debit cash $375. The amount that owed to us also went up. So accounts receivable is going to be increased with a debit of $545. In letter J, we had employee expenses of $510, but we're not going to pay those this time. We're going to pay them next month. They're still expenses because they help produce that revenue that we recorded in the previous entry. So if our expenses go up, we're going to debit the expenses to increase them, but we're not going to pay them, so we don't reduce cash. Instead, we increase the amount we owe. Well, if you increase a liability, you do it with a credit. So our entry there is to debit wages expense $510 and credit accounts payable $510. We've increased our expenses with a debit. We've increased our payables or liabilities with a credit. In K, remember we found that we had used up a lot of our supplies. We only had $30 of supplies left. So we had to reduce our supplies. Supplies are an asset. To reduce them, we credit supplies. And that increases our expense because those supplies helped us generate revenue. So we debit supplies expense to increase it. Debit supplies expense $170 and credit supplies $170. Notice in all these journal entries, our debits come first, our credits come second, and our credits are indented slightly so that we know that they are credits. Finally, in letter L, the customers actually paid us a total of $150 that they owed us. If they paid us, then our cash went up. So we increase the asset of cash by debiting it $150. And we decrease the amount that's owed to us. Remember, that's an asset that we're going to decrease. So we decrease accounts receivable $150. So what I suggest that you do at this point is to go through problem 2, make sure that you understand the increase and decrease, which accounts are affected and which direction that effect occurs, and then look at problem 4 and see how those events and transactions actually are reflected in the journal entries. How do you take those increases and decreases to those accounts and put them in an actual journal entry that will eventually flow through the accounts into the financial statements? So if I were you, I'd take a little bit of time now and look at problems 2 and 4 again. The last problem we have in this section, though, is problem 10. Problem 10 in chapter 4 is at just about the bottom of page 124. And it's going to show you the difference between accrual accounting and cash basis accounting. So let's look at what it's talking about. It says during the month of April, Macon Company had cash receipts of $79,000. This is the actual cash they received. Their expenses totaled $52,000, and their accrual-based net income was $14,000. They didn't have any gains or losses, so they want you to calculate the revenues. Well, now, remember, net income is a result of taking your revenues, subtracting your expenses. Well, we know our expenses, and we know our net income, so we should be able to compute our revenues. So let's look at the formula there on the chart. Revenues minus expenses equals net income. Revenues minus $52,000 equals $14,000 of net income. Therefore, our revenue has to be $66,000. Now, they ask you in Part B to explain why the cash receipts are different from revenues. Not everything is a revenue. You can get cash either before or after you earn it. If you think back to the problem 4 that we just did, often they were mowing yards and not receiving the cash until a later date. So the cash can be actually collected at any time. The revenue is shown when you actually do the work. Whether you have the cash or not, you show the revenue when you do the work. And that's the point of problem 10. So before you go on to module 7, I recommend that you go through and look at problems 2 and 4 again. Make sure you understand the debit and credit process, because in the next module we're going to continue that process and show you the rest of the accounting process.